Okay, so we talked a little bit about partnerships here and there. We talked about, when we talked about the Schedule E and the K1 that we sometimes use to prepare that Schedule E. We talked about how those K1s come from partnerships or from S corporations. So we've kind of talked a little bit about several of these topics, but we're going to go into a little bit more detail. I will tell you that the concept in this chapter that is probably the hardest for students to grasp is the concept, we're going back to basis. We're going to talk about basis. And basis with regard to partnerships is a little more complex because we actually have two kinds of basis, okay? And we'll get into details about those. But basis is extremely important with regard to partnerships, and it's one of those things. So remember when we talked about basis of assets, we're adjusting the basis downward for depreciation, upward for improvement. So it's constantly, it's changing every year, depending upon what we're doing with that asset. Well, a partnership is an asset as well to the owner, right? It's a type of asset for that owner, something they own that they could potentially sell at some point. So we have to know what the basis is for that partnership for when the time comes that we dispose of it, or we sell it, or we give it to somebody else, whatever happens at the end. We have to know what our basis is in that partnership. So it's partnership basis changes. There are a lot more factors that will change a partnership basis though than what changes the basis for other types of assets. And that's what we're going to go into, the types of activities and transactions that affect the basis of the partnership and the basis for each individual partner in that partnership. Okay, so it's, I'm going to use the word basis a lot. I've already used it about 16 times right now. But we talk about it a lot with regard to partnerships. So recall, partnership is when two or more people go into business together, and it is the default form of business organization as far as the IRS is concerned. It is a type of organization that is recognized by the IRS. So anytime, even if you don't file any papers with the state to organize a company, if you go into business with somebody else, it is a partnership. It's automatically a partnership. Even if you go into business with your spouse, it is a partnership. Now, when we talked about the Schedule C, or actually it was the Schedule E, I showed you, you guys remember that check mark for qualified joint venture, where I said married couples can choose this as a way to avoid having to file a partnership return. They're still technically partners when they own a rental together and they're reporting that income, but it's a way to make that reporting a little bit easier. But if they didn't do that, they'd have to file a partnership return. So we've been going over the Form 1040 in detail for individuals. There's our form. For partnerships, they don't file a 1040, they file what's called a Form 1065. IRS loves their numbers for these forms. When we get to Chapter 15, we'll talk about a couple other types of tax returns that are filed for corporations and for S corporations. So we also mentioned earlier that partnerships are a type of pass-through or flow-through entity, right? So, and by that, it means that the income and expenses of the partnership flow through to the owners of that partnership, whether there are 2 owners of that partnership or 300 owners of that partnership. And the income and expenses flow through based on the partnership, the ownership percentage of each partner. So each partner is going to have to pay tax on any income that is attributed to them from the partnership, or they may get to offset any other income on their tax return if they have losses from that partnership. But there's certain time where, again, this is where basis is going to come in with regard to losses and how we report those losses to partners. Okay, so we're going to talk about what happens when we form a partnership. So how we, and again, this is going to go back to basis. When we are putting a partnership together with somebody else, there are different ways that we can contribute to the partnership. We have to value those items that go into the partnership in order to determine what our basis is. So when we first form a partnership, we're going to look at the calculation for all that, how all of that works and the different rules. Partnership ordinary income or loss. Now this is pretty simple. It's the business income rules for partnerships are the same as they are for self-employed individuals. So we're talking ordinary and necessary expenses and same types of income. Okay, so that one won't be too much of a stretch for you. Separately stated items, we also have already previewed that when we looked at that form K1. We talked about how there are the different types of income that are reported on that K1, and maybe you can visualize it, maybe you can't visualize it right now. We'll look at it again further on in the chapter. But we distinguished between ordinary income and separately stated items, and how those separately stated items, we have to pull those out because they're going to be treated differently by each partner, depending upon the partner's individual tax situation. Okay, so we're going to look at what those separately stated items are. Then we got a whole section to talk about calculating partner basis. Okay, we're going to talk about that a little bit up here because we have to have a starting basis. We have to have a starting point for what the value of our partnership is to us, and then items. This calculating partner basis has to do with how we calculate that as the partnership progresses. Distributions. This is kind of a new concept now. Partnership distributions. What a partnership distribution is a partner takes money out of the partnership. Not necessarily in payment for services. In fact, it's not in payment for services. They're retrieving their part of the investment in that partnership. So distributions are treated differently from other sources of income because it's not really considered income. Oftentimes what a distribution is it's money you put in that was already taxed, and then you're just taking it out again. So it's not going to be taxed again a second time. So distributions are not in and of themselves taxable to those partners. So it's possible to get money out and not have to pay tax on it. But the thing is, you've already paid tax on it at some point in the past. So we'll look at those partnership distributions and what happens when we liquidate or dispose of a partnership. So when we sell our portion of the partnership or when the partnership goes out of business, what is our tax treatment? Because like I said, partnership it's an asset. So when we're getting rid of it in one way or another, we're going to have some taxable event that occurs. Okay. So that kind of gives you a little preview. Let me see if what this next page is talking about. We'll talk about this too. So it can get a little bit confusing because we have businesses. The IRS recognizes business formations and the state recognizes business formations. So with regard to the state, we're talking about legal entities, not tax entities, right? So the state may recognize certain types of entities as legal entities that the IRS then doesn't recognize as taxable entities. So we have kind of these two different categories of business entities, one that the state recognizes, one that the IRS recognizes. Now, in most cases, they do overlap. So the state recognizes partnerships. The state taxes partnerships. They recognize them as a legal entity. They recognize them as a taxable entity as well. Corporations, the same thing. They recognize them as a legal entity and they recognize them as a taxable entity. One category of business, though, is recognized for legal purposes under state law, but it's not really recognized as something unique or separate under tax law, and that is an LLC. I'm sure a lot of you have heard of that term LLC. Maybe you've seen it when you see a business name and it says comma LLC. LLC stands for Limited Liability Company. One of the disadvantages of partnerships, if they are not organized as legally as a limited liability company, is that the owners of the partnership are personally liable for the activities of that partnership. Now, one of the big reasons that people will form companies or corporations, well, one of the big reasons they'll form corporations is to protect themselves from personal liability for the actions of the corporation, because now it becomes a separate legal liability. So if somebody sues that company, they can't go after the owners. That's what that legal liability provides. But if you are a partnership without having formed an LLC, or if you don't have a corporation, you do not have that liability protection. That means if somebody comes into your business and they trip on a broom, they can personally sue you if you don't have that liability protection. So the IRS doesn't recognize this, but the state does. Now, and I know I'm kind of getting into the weeds here, but it's confusing when our textbook, a tax textbook, starts talking about an entity that's not a tax entity. It's a legal entity. Limited liability companies could be partnership and therefore taxed as a partnership. They could be a sole proprietorship and therefore taxed as a sole proprietorship. They could also be what's called an S corporation and therefore taxed as an S corporation. So it could be any one of these types of tax entities. Right? So this is illegal. These are tax. So if somebody says, hey, I have an LLC, what tax form do I fill out? You can't really answer it if all you know is that they have an LLC, because it could be that they have to file a 1065. It could be that they have to file, if it's only a single owner, they file it with their Schedule C on their Form 1040, or it could be that if they're organized as an S corporation, that they file what's called an 1120S form, okay? So a lot of, and you'll see, they also talk about LPs. These different acronyms, so it just depends on the state. Different states have different names for these. I think actually Iowa has, I don't know if they're LPs or LLPs. We have LLCs and LPs, but that is a way of organizing the business to protect the owners from liability, from personal liability. So, like I said, if somebody comes in, injures themselves, they can't go after the owner's personal assets. They can only go after the assets of the company. So it provides a barrier there. Does that make sense? Yes? No? Okay. All right. So in our case, we're going to talk about these partnerships, which, like I said, could be LLCs, might not be LLC, or, yeah, they could be LLCs, they